Welcome to the Iron Financial Explainer. Look, I'm your lead analyst, and my mission today is pretty straightforward. I want to help you cut through the current market weakness, identify the actual structural integrity of your investments, and ultimately forge a much stronger portfolio. Right now, if you're watching the broader medical technology sector, you know it is under intense, massive scrutiny. Capital is getting really expensive, hospital budgets are tightening up everywhere, and these companies are being forced to prove their actual durability. So today, we are putting GE HealthCare right under the heavy machinery. We are stress testing their Q1 2026 earnings to figure out if this company is laying down a rock-solid foundation for the future, or if they're just forging a value trap that's about to collapse on investors.
And I'm the Market Skeptic. I'm here representing you, the audience, because let's be real, I do not want the corporate spin, and I absolutely don't want the hype. I want to know if the growth they are constantly talking about is real or if the stress fractures are already starting to show up. Because when I sit down and evaluate the surface of these new numbers, something just doesn't add up for me.
Okay, so let's just dive right into this immediately, because this is the exact hook that caught my attention from the get-go. How exactly does a massive, mature company like GE HealthCare report a very respectable 7.4% top-line revenue increase, yet somehow manage to drop a massive anvil on their profit outlook in the exact same quarter? I mean, they are bringing in significantly more money, but they're keeping significantly less of it. Make it make sense.
Right, and that is the exact structural flaw we are drilling down into today. You have to realize a revenue increase of 7.4% in the heavy healthcare sector requires immense, grueling, heavy lifting. You got to remember, selling complex medical machinery isn't like selling consumer software or sneakers. These are incredibly long, difficult sales cycles that are totally dependent on massive hospital capital expenditure budgets. So delivering that kind of top-line growth, that shows the demand is absolutely undeniably there. But you are 100% right to be skeptical. The bottom line is bleeding out, and we need to understand if this is just a temporary dent in the bumper or if it's a sign of a total structural failure. But to really understand where the corrosion started, we first have to go back and inspect the original blueprint.
Section 1. The Blueprint. A solid 2025 foundation.
So before you can spot a structural collapse, you really have to know what a solid foundation looks like in the first place. And by all accounts, GE HealthCare's full year 2025 was built on absolute bedrock. Think about the context. The company was in its third year as a standalone public entity, right? And they were aggressively executing this heartbeat lean business system to drive internal productivity. The market absolutely loved it. They entered 2026 with serious momentum, a really robust balance sheet, and a management team basically taking a victory lap over their operational resilience. I mean, total revenue in 2025 hit $20.6 billion. That was up 4.8%. Net income attributable to GE HealthCare was a very healthy $2.1 billion. They maintained an adjusted EBIT margin of 15.3%, and their free cash flow engine just pumped out $1.5 billion.
Yeah, that free cash flow number is massive. That's the one that jumps out to me.
It is absolutely vital. You know, for a newly standalone entity, generating $1.5 billion in free cash flow, that proves you can actually fund your own operations, you can pay down your debt, and you can invest in research without having to dilute your shareholders or take on really expensive new loans. They even finished the year with a record backlog of orders. This whole setup gave investors immense confidence in the stock's long-term durability. The scaffolding was up, the concrete was poured, and the 2026 guidance they issued back in February promised solid growth across all these metrics.
Section 2. The Inspection. Drilling down into Q1 2026.
All right, I need us to pull up the tape on Q1 2026 right now. I want to see exactly where this foundation started cracking. Because look, you don't go from a corporate victory lap in February to a massive profit warning in April without some serious internal friction.
You are absolutely right. The market absolutely hates surprises, and Q1 2026 delivered a really painful one. What is really interesting about these Q1 numbers is the glaring divergence taking place. The top line is doing exactly what it's supposed to do. Revenue grew from $4.77 billion in Q1 of 2025 to $5.13 billion in Q1 2026. That is driven heavily by product and service growth, specifically really robust demand across the US and EMEA regions for their core imaging technology. Basically, hospitals are out there actively upgrading their fleets. But the net income just bled out. Net income attributable to GE HealthCare dropped from $564 million down to just $389 million. That is a 31% collapse year over year.
Right.
And then the adjusted EBIT margin contracted from 15.0% down to 13.5%. That is a 150 basis point drop. Now, in the world of large-cap medical technology, a 150 basis point margin compression in a single quarter isn't just some accounting rounding error, it's a massive red flag. It literally means the cost of doing business is accelerating way faster than the cash actually coming in the door. And here is where it hits the retail investor's pocketbook directly. Diluted earnings per share plummeted from $1.23 in Q1 of last year to just 85 cents this quarter. That is a massive 38-cent blow to the financial framework.
Yeah, and that drop changes the entire valuation math for Wall Street. Institutional investors build their incredibly complex models on predictable earnings growth. When you suddenly wipe out nearly 30% of the expected EPS in the first quarter, the algorithms sell and the portfolio managers head straight for the exits.
So my main question to you as the lead analyst is this. Is this 38-cent drop a temporary blip, like a pothole, or are we witnessing total systemic structural decay?
Well, to answer that, we have to actually tear down the company segment by segment. A conglomerate like GE HealthCare isn't just one single building, it's a complex of different, interconnected structures. Some are holding the weight perfectly fine, and others are literally crumbling under the pressure. Let's break down the segment warfare happening internally.
So, let's break down these internal stress tests. First, you have the heavy lifter. Pharmaceutical Diagnostics, or PDEX. This unit is forging ahead with just sheer strength. Revenue rose to $770 million, which represents a fantastic 21.7% growth. This was heavily aided by strong commercial execution with specialized high-margin products. We're talking about things like Flyrcado, which is an advanced imaging agent used in PET scans, and the recent integration of their NMP acquisition, which totally fortified their radiopharmaceutical capabilities. It's basically the steel beam holding up the revenue numbers right now. But then you have the weak link, Patient Care Solutions. A weak link is putting it mildly. PCS revenue dropped to $704 million, which is an 8.1% organic decline. So while imaging and PDEX are pulling their weight, Patient Care Solutions is out there actively rusting out the entire portfolio. Just how bad is the internal decay in that specific segment?
Honestly, it's staggering. The absolutely crucial point is this figure, 1.4%. That is the EBIT margin for the Patient Care Solutions segment in Q1 2026. Segment EBIT for PCS fell to just $10 million. That represents a massive 500 basis point contraction down to a razor-thin 1.4%. Wait, hold on. 1.4%? They are basically running a non-profit organization at that margin. Exactly. They are practically moving that highly complex medical equipment at cost. This right here is a brutal, real-time lesson in operating leverage. For those listening, operating leverage is basically the relationship between a company's fixed and variable costs. In heavy manufacturing, you have massive fixed costs. Huge factories, heavy machinery, ironclad union contracts. You have to pay those no matter what. So when your sales volume drops even slightly, or your variable supply costs suddenly spike, your profit margins don't just gently decline, they fall right off a cliff. Selling incredibly expensive machinery at a 1.4% margin leaves absolute zero room for error if supply chains even slightly hiccup. When a core segment of your business sees its profitability collapse by 500 basis points due to lost operating leverage, you have a severe structural imbalance.
Section 3, cracks in the armor, cost headwinds. Moving right along. Okay, so we've clearly identified the weak links, but a 31% drop in overall net income isn't just happening in a vacuum because of one segment. I demand some clarity on the macro environment. What specific macroeconomic rust is out there eating away at GE HealthCare's bottom line so aggressively across the entire board? Well, the 10Q filing outlines a pretty brutal combination of cost inflation, incremental tariffs, and increased design investments that basically raised all their product costs. The structural damage is coming from multiple angles at once. First, we are seeing pronounced, sticky inflation across their entire supply chain. Management specifically highlighted significant increases in the cost of memory chips, oil, and freight expenses during the first quarter. Add to that the heavy weight of incremental tariffs impacting their gross profit. They also dealt with a discrete supplier issue in their heavy-lifting PDX unit, though to be fair, they said that has since been resolved. Right, and don't forget the geographical pressure. I read in the 10Q that China declined by approximately 4.4%. This was heavily impacted by local competition and aggressive volume-based procurement pressure. And just a quick note for the audience, volume-based procurement is when government entities group their buying power to essentially force manufacturers into a massive bidding war. You might win the massive volume contract, sure, but you have to slash your prices right down to the bone to get it. So you have input costs skyrocketing globally and relentless pricing pressure in massive markets like China. That is an absolute vice grip on your margins.
Which actually leads us perfectly to this quote from CEO Peter Arduni. He says,
Profitability in the first quarter was impacted by a PDX supplier issue. Given these dynamics, we are taking a prudent approach and reducing our profit outlook. Now, lead analyst, I really want your unfiltered read on this. Is management just sandbagging their numbers to intentionally lower Wall Street's expectations so they can easily step over a much lower bar later this year? Or are they genuinely panicked about losing their pricing power in a vicious inflationary environment? Honestly, it's a mix of both, but mostly it's a forced reality check. Look, they assumed a certain manageable level of inflation when they built their 2026 blueprint back in February. The reality of Q1 just smashed those assumptions to pieces. Think about how fast global freight rates can swing, or how a localized shortage can literally double the spot price of the memory chips required for their imaging machines in a matter of weeks. They aren't panicking, per se, but they are definitively acknowledging that the structural load they're carrying right now is much heavier than they anticipated.
Section 4. Rebuilding the 2026 Outlook. Revised Guidance.
So when the foundation shifts, you have to redraw the blueprints. We need to inspect whether the remaining structure can actually hold the weight of these pronounced inflationary costs for the next 9 months. Now on the top line, they are maintaining their guidance of 3.0% to 4.0% organic revenue growth. The customer demand is absolutely there, no question. They have a massive $21.8 billion backlog and a book-to-bill ratio of 1.07 times.
Let's clarify that specific metric for a second. A book-to-bill ratio of 1.07 times means that for every single dollar of equipment they ship out and bill for, they are booking $1.07 in brand new orders. That means the demand pipeline is literally growing faster than they can physically build and ship the machines. The volume is solid bedrock.
Exactly. The volume is great, but the profitability is the sinkhole. They actively downgraded their adjusted EBI margin expectations to a range of 15.4% to 15.7%. That's down from the 15.8% to 16.1% they promised just a few months ago. They are flat out admitting that even with incredibly strong sales, the raw cost to deliver those sales is eroding the foundation,
which directly forces a nasty downgrade on the bottom line. The newly revised adjusted EPS guidance is the cold reality for shareholders here, lowered to a range of $4.80 to $5.00. Ouch! That is a very clear step down from the original promise of $4.95 to $5.15. So if you look at the midpoint, they just wiped 15 cents of earnings per share right off the table for the entire year, simply because they misjudged the cost of memory chips, oil, and freight. Yep, and the psychological blow of this on Wall Street cannot be overstated. When a management team has to publicly walk back their full-year profit promises barely 3 months into the fiscal year, it totally shatters the illusion of control. It forces every single analyst covering the stock to instantly discount their future cash flow models, punishing the stock price immediately. And the internal friction gets even worse when you look at the cash generation. Free cash flow guidance was cut from $1.7 billion down to $1.6 billion. That's a $100 million downward revision. Lead analyst. Is the company's internal cash generation engine beginning to stall out under the pressure of these capital expenditures and cost headwinds? Well, it's not stalling entirely, but it is certainly downshifting a gear. The 10Q shows they actively expanded manufacturing capacity and increased design follow-through expenditures. And to be fair, those are necessary long-term investments. A prime example is the Intelerad acquisition, which they bought to aggressively expand their cloud-first enterprise imaging solutions. They are essentially building out a software ecosystem that hospitals can use to manage scans across their entire network. That burns intense cash today for a sticky software-as-a-service payoff tomorrow. But when you combine high investment burn with high supply chain inflation, your free cash flow naturally compresses.
Section 5. The Verdict. Trap or Opportunity? Let's bring it home.
All right, we've inspected the blueprints, we've drilled deeply into the Q1 tape, and we've analyzed the structural decay in the margins. It is time to deliver our final no-nonsense assessment of GE HealthCare's true structural integrity. Management isn't just sitting there letting the inflation crush them. They explicitly stated they expect to offset more than half of the inflation impact with strategic price and cost actions. Sure, but what does that actually mean in the real world? What actions can they practically take? It means aggressive operational combat. They're going in and renegotiating supplier contracts, they are optimizing their global distribution logistics to cut down on those exorbitant freight costs, and they are ruthlessly leaning into their pricing power to force hospitals to absorb some of the pain. They're attempting to patch the leaks in real time. But more than half still leaves a massive chunk of inflation eating directly into shareholder equity. It's a defense mechanism, sure, but it is a clear admission that they cannot fully protect the fortress. The market is aggressively reacting to this margin compression. But hey, as Iron Financial listeners know, volatility creates opportunity if you actually know what you are looking at.
So we have a really stark contrast here. On one side, you have revenue growth, a massive $21.8 billion backlog, and incredibly strong demand in PDEX and imaging. On the other side, you have heavy financial scrutiny required because net income is down 31% and the patient care solutions segment is practically on life support at a 1.4% margin. I demand a definitive call from you. Does this stock have the structural integrity to survive the year, or is it a trap? The growth is absolutely real. The top-line performance and the backlog prove beyond a doubt that healthcare providers desperately need GE's advanced medical technology. Look at their AI cloud solutions, for example. They are using artificial intelligence to drastically reduce MRI scan times, allowing hospitals to push way more patients through the machine per day. That is incredible ROI for a hospital. So the demand side of the equation is rock-solid bedrock. The weakness we are seeing is entirely on the cost and margin side of the house.
So here is the final hammer blow. GE HealthCare is a structurally sound company that is currently carrying an incredibly heavy macroeconomic load. The 7.4% revenue growth proves they are forging a stronger portfolio of highly in-demand products. However, the severe margin compression, particularly in that patient care solutions unit, proves the immediate operating environment is highly hostile. If you are looking for a quick, flawless quarter, you are stepping into a trap. But if you believe management can successfully leverage their pricing power to reinforce the foundation, execute those strategic cost actions, and clear that $21.8 billion backlog over the long term, this current market weakness might just be your perfect entry point.
It all comes down to whether you trust the foreman to fix the framework before the next earnings call.
Exactly. That's the Iron Financial perspective. Dig into the numbers, stress test the foundation, and always build a stronger portfolio. But hey, we want to hear from you. Are you buying the dip on GE's backlog, or are you waiting for the concrete to dry? Let us know, and we'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.